Hey folks, how you doing? Happy New Year. First little update in a while. So wanted to start right at the top. Where have I been? What have I been doing? Towards the end of last year, it was manic with bridging. We ended the year loaning out £3.5 million of new business, which is absolutely fantastic. That's spread across all shapes and different sizes, from humble baby buy-to-lets at 40, 50, 60,000 pounds all the way through to small scale commercial conversions around the £500,000, £650,000 mark. So a lot of varied projects in there, a lot of success, and we're building on it this year. So before I get into the projects that we're working on for the first half of this year and a little bit of an interest rate update on my predictions, or what the market's predicting for the first half of this year in terms of interest rates, just wanted to tell you a little bit about Dan's World Tour this week. Monday, I was at MAPS in Coventry with Mark Dalton and the gang there. So that was a great network. That's for beginners, from the first couple of buy-to-lets, portfolio building, all the way through to extensive portfolios. And the guest speaker we had, Mark Winship, was building his own hotel brand, which was really exciting stuff. Service accommodation has certainly been a flavour since COVID, juicing returns of otherwise less intensively income producing property. Where else? Tomorrow I am off to Glasgow. I'm up there speaking at Heather Mortimer's event, which will be absolutely fantastic. Hope to see you there. If you're local, it'll certainly be worth the trip. A little bit about where I began my first project down in South Wales, all the way through to the latest London purchases. And on Saturday this weekend, we're in Belfast, Northern Ireland. Mark's running his Angel Getting Day. If you want more information on that, if you're struggling with raising angel finance, it's certainly a great course, and grab a hold of me if you'd like more information on that. Now, without further ado, the 5 bridging projects that we're working on for the start of the year. So we have all shapes and sizes. We've got low value loans, 40k and 50k. We've got a bit of a creative purchase with some vendor financing at 120k. We've got a flip for 275k, and we've got a commercial conversion for 265k. So there's a plethora of different types of projects there. The underwriting criteria for us all remains the same, but let me dive into each of those with a little bit more detail to give you an idea of the types of projects people are doing and the types of projects that we're funding. So the 40 and 50k, it's a repeat borrower, someone that we've known for many years. It's a small town up in the northeast, and these we've actually funded the project 108 on the street. We've actually funded 106 on the street quite a few years back. So yeah, that was interesting to see. I was well aware of values, tenant type, done up value, and cost, approximate cost of what a refurbishment should be in that area before getting much due diligence on this project at all. So that was cool. These are 3-bed, 2-reception mid-terrace properties that are being renovated and let to a social housing provider. So the social housing provider that this borrower, investor, has got a contact with, they would take a 3-bed, 2-reception terrace property and let it on a 4-room basis. So it does push that rental up that little bit. So traditionally, social housing would pay a little bit less than private rented, but because this social housing is using 4 rooms instead of the 3, it does actually push just beyond what you would expect to receive from the private rented sector, except there's limited maintenance because the social housing provider would take care of most things other than boiler, roof, structural issues. They would carry out with routine painting, carpet cleaning. If anything's broken maliciously, obviously they would pay. They would pay for the repair of that. It's without tenant churn, so you don't have the tenant turnover. Traditionally, these social housing providers would take properties on a 3, 5, maybe even 10-year basis. The only con with this strategy is that you need to be really mindful of mortgages. The back end, we'll come to mortgages when we're talking interest rates, but this type of property with this type of tenant would require you going to a specialist mortgage company. You wouldn't have the cheapest mortgages available on the market. And so because you have fewer lenders with an appetite for this type of project, you need to be mindful of what their minimum loan amounts are, because if their minimum loan amount is £100,000, your property's not worth that much, then you've got a financing issue. So making sure that you've got certainty and that the whole puzzle fits together is really important on the way into the deal. So there's 2 of those. There's a 50k purchase and a 40k purchase. 50k loan and a 40k loan. The purchase prices vary slightly, but the refurbishment is largely the same, and it's very slightly different done-up values on those as well. So great deals, great income producing properties. We absolutely love those. The next deal, we're talking about the vendor financing project. So this is £120,000 loan. The vendor is contributing the deposit here. So the property is worth about £195,000. The survey came back at, we're lending £120,000. Now that £120,000 is the figure that is currently owed to the bank. However, the borrower doesn't have deposit monies to pay across. Traditionally, your straightforward mortgage lenders or your more vanilla bridging finance lenders, your stricter criteria bridging finance lenders would want to see the borrower put down £60,000-70,000 here in the form of deposit. Now they don't have that. The contribution is coming through the vendor, and so that vendor equity we're allowing that, and the transfer and the purchase can conclude on that basis. Again, a little bit quirky. It's not for every lender, but there are lenders out there that would look at vendor financing, so it's an option. Finally, the last two that we're looking at, we've got the flip. This is a project on the Isle of Wight. It's a bungalow purchase. The borrower has additional equity, so they've got a first charge over a cottage available, as well as the first charge over the project property. This project, the bungalow is being converted from a 2-bed into a 3-bed by incorporating the conversion of an integral garage. Purchase is around £203,000. I think the refurbishment was around £35,000. The value for this property for marketing after works, we're expecting, I think we've got a band of 295k up to 320k, so around 300. There's plenty of meat on the bones there, with a spend of 230, financing costs of £30,000. The borrower stands to make somewhere in the region of £40,000-50,000 from that project, so absolutely fantastic. Finally, the fifth project that we're looking at is a commercial conversion into HMO. This is a purchase pre-planning, so planning has been submitted, but the decision hasn't come back yet. I caveat, this is not a strategy for your first commercial conversion in the area. A lot of developers are offering subject to planning, negotiating on if we get planning, we will buy at this price. Doesn't work for all vendors. So if the offer subject to planning price might be up here, the buy now price might be down here. Because you're taking planning risk, you can negotiate that bit harder. And if you're confident in the market, if you've got an extensive experience with the council and what they want and what they'll allow, if you've got a professional architect and town planner in your team that know the area and know it well, then this is the type of risk that might be worth taking, but certainly not for your first project. These guys are HMO specialists in their area. They've got an extensive experience of sourcing, converting and managing HMOs, and they're absolutely fantastic end-to-end solution. So are we confident that they can deliver this type of project? Yes. The numbers are, I think, purchase 265, renovation is 400k, of which they're funding through their own means. There is a second charge vendor financing equity, again in this, so a little bit quirky from that respect. And it's to be converted into a 17-bedroom HMO, the old commercial unit. It will be split into a number of sort of cluster flats. So in previous projects, they've done a 16-bed with 4 4-bedroom flats, and this is going to be of a similar like. Finally, so that's the 5 projects that we're working on, all in legals at the moment. Hoping to conclude those. The first one on a Friday of this week. We shall see. There are some legal quirks that we need to jump through and organise. Moving from there, we have interest rate updates. So where are interest rates at the moment? So for the last sort of year and a half, they've been they've been talk of the town. They've been rising. There was a big spike after the quasi-quartering budget, sort of September 2022, and then rates were massively on the rise through the majority of 2023 to really get on top of inflation and stem the spending of the consumer. In that time, when rates are moving up and up and up, banks have to bake in a margin of safety on their mortgages. So if they're offering you a mortgage at 4%, they need to add fees. If cost of finance is at 4% for the bank and they're lending out at 5.5%, they need to bake in some contingency, some margin of safety through these fees to make sure that they're not underwater on these mortgages. In an environment of rising interest rates, the uncertainty of the continued rate rises will mean that margin is bigger. So there has been a bit of stability sort of returned in the last 3 to 5 months maybe, in that the Bank of England have held rates on, they've put them on pause. So they went up to 5.25, pretty consistently up. At 5.25, they have paused. They've paused for the last two, and that's been a spread of maybe 3 or 4 months now. So lenders are starting to be able to offer discounted rates based on that. So their cost of funding is getting more consistent. There's not looking like there's spikes. And so these discounts are now moving into the market for borrowers to benefit from. Now, who benefits where first? The first people to benefit are your mums and dads, people that have a significant amount of equity or a sizable deposit. So more than 40%. So if your loan to value is sub 60%, you'll be the first people to benefit from these discounts on your mortgages. I think the latest one that I looked at got a personal primary resident mortgage. So it's a mortgage over your own home, your personal primary residence. About 6 months ago, we were looking, well, not even, 3-4 months ago, we were looking at 5.5, 5.7% on a 5-year fix. That's now 3.89. So lenders are seriously cutting these rates. You'll be seeing it everywhere in the news. So first, that was with the co-op. The first people to benefit are your personal primary residence homeowners with sizable deposits. Then it will slip up through the LTVs. Then the next people to benefit will be your standard buy-to-lets. So your basic buy-to-lets, lets that have a very good affordability ratio cover. So again, different lenders. The lenders that are strictest offer the cheapest rates. So lenders that have the strictest rental affordability test, meaning your rents need to be the highest to borrow this amount, they will have the first discounts, make them available to borrowers. After that, then we're moving to the specialist mortgages, a bit like I mentioned earlier, the social housing mortgages. These are a little bit complex. Look, people don't want to be evicting tenants that don't have jobs, that have learning difficulties. It's not a good PR for Lloyds Bank. So, for example, big up Lloyds Bank, absolutely. These types of lenders that do lend on those projects, they charge a premium for it. So again, they've got a less strict criteria, and because they are less strict, they charge a little bit more. So they will be the next people to feel the discount and pass the discount on to borrowers, people funding those types of projects. Finally, last but not least, are commercial. So commercial mortgages are things like a shop with flats above, maybe just a straightforward office mortgage, your large hotels, I mentioned Mark Winship, those types of projects, they're commercial loans. So they are going to be the last to benefit from the discount in these interest rates. When is bank rate due to come down? Talk of the town is that it's going to be sometime around in May. If it's sooner than that, we have overshot it. If it's later than that, we risk pushing the economy further into recession. So yeah, that's it. That's where we're up to in terms of mortgages. Look, as soon as those mortgages do start dropping, everyone is going to be out buying. 2021 was a horrible time to be buying. Everyone and their dog was buying. What's the asking? Yeah, I'll add 10. So for serious investors that are busy, that are buying in all markets, things at the moment are about at equilibrium. It works to be a seller, it works to be a buyer. Provided things stay steady here, plain sailing, happy days. You can do deals on both ends of the market. If those rates drop too aggressively, that's going to swing. Everyone who is selling stock is going to benefit, but finding deals and picking them up is going to be much more difficult. So that's where we're up to. I'm looking forward to getting these deals over the line and looking at other inquiries. If you've got anything that you want specific help with, please do shout. But yeah, look forward to seeing where the year leads. Thanks for tuning in. Take care.